John, on the day we have Meta up slightly, Twitter's up a bit more, Tesla, the proxy for Elon Musk, up 1.4% on the year. Tesla up 125%, Meta up 143%, probably the early stages of the fight, but again, they will probably be looking for either an injunction or some sort of monetary damages. But how do you calculate the future and what it could mean? Stay tuned.
Abby, thank you. You mentioned Tesla. Let's turn to Elon Musk's other company in the news as well, providing fresh incentives for potential buyers in China, running the following. Buyers will get 3,500 yuan in cash and a 90-day free trial of enhanced autopilot if they make the purchase via referral from another Tesla customer and take delivery within a certain period. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, John. Tesla is up 1.3%. Several pieces of news. The near-term driver of the stock is news crossing the Bloomberg terminal in the last 20 minutes that Mercedes-Benz is joining Tesla's charging standard here in North America. From 2024, Mercedes-Benz customers will have access to the supercharger network via an adapter, and Mercedes, like many others in its industry, later offering an engineering fix or production fix to match that standard while also building out their own network. The piece that Bloomberg reported overnight, in addition to what you said on China incentives, is that Tesla has started making some workforce reductions on the battery team in Shanghai, according to sources. There are 20,000 people that work in that Shanghai plant. What we're talking about is individuals on the team that take the cells from third-party suppliers and assemble them into modules and packs. One source told us that an element of this is because there is an aspect of automation that can replace some of those jobs. But this comes at a time where we are talking quite a lot about the price war, quote unquote, in China and the compromise that was reached in the last 24 hours. The third piece of news very quickly, Mizuho raising its price target on the stock to $300 from $230, maintaining a buy rating. If you're a Bloomberg terminal user, go on A&R and just take a look on the top right-hand corner of the screen. The average 12-month analyst price target is 222.55. Tesla trading at 279 currently, and you'll see that since the news flow around other automakers joining the NACS standard charging standard, that's where the stock's really taken off. But it's taken time for the sell side to catch up in that respect. We're now kind of on an upward trajectory in terms of how the sell side see this stock going currently, John.
Ed, you made 3 points. Let's pick up on the second one. Just the cuts of workers in China. Can you build on that a little bit more? Can we read into anything about demand potentially in that country, given where deliveries came in so well in the last few months?
The use of price cuts as a lever based on the latest quarterly production and delivery data indicates that did work in a market like China, where there are many more domestic players offering a wider range of battery electric models. BYD is a great example, right, where in that country they also sold more than 300,000 battery electric units, and if you extend that to plug-in hybrids, more than 700,000. What I've learned in speaking to sources is that it is normal in all of Tesla's facilities for them to review the structure of the organization and just make logical changes, trim teams or reallocate headcount. And we did report, according to sources, that those battery module assembly members that the jobs were removed were offered in some cases chances to move to other teams in the facility. And again, 20,000 people work in Shanghai, John, for Tesla, and that plant accounts for more than half of output last year. So it's kind of shuffling the deck, but it is worth tracking the minutiae of what's going on there.
Stock is up about 1%. Ed, thank you. The latest on Tesla there and Elon Musk. I want to turn to the financials going into earnings next week. Wolf Research upgrading JP Morgan to outperform, downgrading Wells Fargo to peer perform. Wells Fargo management has executed well, but shares have outperformed and valuation has converged with peers, while our JP Morgan upgrade is far from contrarian. We believe guidance will prove conservative. Shonali Basak back with us for more. Hey, Shonali.
Good morning, John. You're taking a look at Wolf Research. Look at two of the banks that are trading better than any of the banks in the system as far as the top six goes. Listen, when you take a look at Wells Fargo, Wolf Research's move here goes against the grain. 70% of analysts still say buy Wells Fargo. But what they're looking at here are the risks on the horizon, commercial real estate risk, regulatory risks. The reason the timing here is interesting also, John, is because you have Wells Fargo and JP Morgan Morgan are two of the banks that raise their dividend among the most of the big banks as well. So they're giving something back to shareholders. They're performing, but with Wells Fargo trading at about book value, you have Wolfe Research now telling you maybe book value is just enough. JP Morgan's case is the bull case, and JP Morgan's case applies to other banks as well here, John. It's the idea here that capital markets, not necessarily all investment banking and trading, but the return of capital markets, IPOs, debt underwriting, will help banks like JP Morgan and Bank of America moving forward. That is the money case of the second half, according to Wolfe Research.
Shanali, leading our coverage starting in about a week from now. You get some rest this weekend. Shanali, thank you. Looking ahead to JP Morgan results next week. Before we get there, of course, the CPI report. Behind us already today, earlier this morning, the payrolls report. Stocks wavering. Treasury yields near 2023 highs after a cooler than expected payrolls report at the headline. Mohammed Al-Arian weighing in earlier in the program.
Despite the miss on job creation, this will not get in the way of the Fed hiking in July. It will moderate expectations as to what happens thereafter. But with the wage growth, the labor force participation, and the unemployment rate, these three things means it will hike in July.
Two of the best on this. Let's get straight to it. Crossmarks Victoria Fernandez, PGIM's Mike Collins. Mike, first to you, buddy. Your thoughts on that payrolls report an hour ago?
Yeah, Jonathan, I think it's a really simple message consistent with our view that economic growth is moderating, labor force growth or labor growth is moderating, wage growth is moderating, but it seems to be stuck kind of in the 4+% area, which is a little problematic. That's probably 50 to 100 basis points higher than the Fed wants to see wage growth. The breadth of labor market is waning, right? You're seeing the gains really in a few sectors now, which is kind of a leading indicator of maybe weakness ahead. But there's not enough leverage in the system for a big hard landing, right? So you're going to see a moderation in growth, a moderation in inflation. The Fed is going to hike in 3 weeks from now, 19 days from now. I think that's a done deal, but the threat of a hard landing is really low here.
Is it a done deal, Victoria, from your perspective?
Yeah, I think that at the July meeting, we're definitely going to get a hike at that point. You've just heard some of the hawkish talk from the Fed, even just from the last meeting, talking about the expectations of at least 2 hikes. And so I think given July and the jobs report that we've seen, I think it is a given. The labor market is key for them because it has the average hourly earnings, and labor cost is what's keeping inflation along with rents, but it's what's keeping it sticky right now. So they're trying to figure out how can they bring those labor costs down. You have average hourly earnings up 4.4% year over year. As Mike used the word stuck for that, then I think that's a way that the Fed is looking at it. They're stuck right now, and what can they do to improve it? Because look at some of the other elements of the labor market, Jonathan. You've got quit rates that were up in the JOLTS report yesterday. You've got longer-term averages that are coming down. Continuing claims were at a 5-month low.
Yeah.
So you've got elements that are telling you this is still strong and the Fed has more to do.
The work week lengthened. So let's talk about what we've got in this bond market now. 2-year just south of 5%, 493. 10-year at the moment just north of 4%. Mike Collins, how active have you been this week? Is that a buy on a 10-year at 4%?
Yeah, we, as you know, Jonathan, have been short duration here for a couple of months, really since the dust settled on the regional banking crisis, mostly in the belly of the curve, so long kind of cash and a little bit long the very back end, but that whole intermediate part of the curve is again pricing in still probably too many aggressive rate cuts too soon. So we've been short that, but with this big backup in rates, as you mentioned, I mean, the 5-year is up 100 basis points really in a couple of months. 5-year real rates are up 100 basis points. The numbers here, that 4 handle on 10-year treasuries is starting to get more appealing. We believe we're going to be in a range, say 3.25 to 4.25 on the 10-year. As you get toward that higher end of the range, you have to cover that underweight, and we've been doing that. We've been reducing our underweight really in duration.
Interesting. Mike, let's keep building on that. Mike Collins, Victoria Fernandez, they're going to stick with us. We'll work through this market. Price action, yields near 5% on a 2-year in the last 24 hours. We back away from that. Equities right now just a little bit negative. Coming up, a downside surprise in the payrolls report.
We are the envy of the rest of the advanced world. We mustn't forget that this economy is, in relative terms, outperforming many other economies.
Reaction down in Washington, up next. Live on Bloomberg TV and radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting US Secretary of Labor, responding to the labour market report from about an hour and 15 minutes ago. Secretary Su, fantastic to catch up with you. Just your first reaction to the payrolls report from earlier this morning, and whether we're seeing broad-based strength in this economy or something that's showing us things are slowing down.
Good morning, Jonathan. Thank you very much. This is a good jobs report. It represents steady and stable growth, which is what we want. It shows that the president's policies, Bidenomics, is working. It's combined with a 3.6% unemployment rate. Many predictions were that it would not get below 4% right after the pandemic-induced economic crisis for a long time, and these policies have defied that. And in fact, we've seen less than 4% unemployment for 17 consecutive months now, which is the longest duration since the 1960s.
We know we've got a bit of tension out there in the labour market at the moment, and you've been involved in some of that, so I want to build on some of it with you. We have a tentative agreement covering West Coast port workers. That's been an issue for a while. I know you've had some involvement, so congratulations for that. We now have a new issue, so let's talk about that one. The potential for 300,000 UPS workers to go on strike. How involved are you in those discussions with the union and UPS?
Yeah, thank you, Jonathan. Thanks for mentioning the port, because those parties worked very hard for over a year and did reach a tentative agreement recently. It still has to be ratified, so the process is not over, but it demonstrates that collective bargaining works and that you can reach agreements that are, as the president often says, good for workers, where companies can profit, and it's good for the economy as a whole. And there remain other negotiations that are going on, right? That's what it means to be in an economy where workers have some power, where unions are at the table, and we are monitoring the negotiations, but trust that the parties are going to do what they need to do.
Have you spoken to UPS? Have you spoken to the union involved this week?
Yeah, I've been in touch with both parties. I've also, just in my role as acting secretary, talked to parties to these negotiations, as well as unions and employers across the economy. And so again, I'm hopeful and know that that they're going to continue to do what they need to do, and that a fair contract is something that that everybody hopes that there can be win-wins, as we saw at the port.
Secretary Sue, I've heard that word thrown around quite a lot by this administration, this word fair. And language is important, it's meaningful. What would fair be?
Right. So this president has been very clear that fairness and equity is very important, and that we can build an economy that is fair and equitable, meaning from the bottom up and the middle out, right, where nobody gets left behind, where we invest in the middle class. Bidenomics is all about investing in America, and in particular industries like semiconductors and manufacturing and infrastructure, but also investing in American workers, and also increasing competition to decrease prices. All those things are part of what President Biden believes is fair, and what we believe this jobs report demonstrates that a strong and fair economy can be.
That's all great, but we have to define what it means. For UPS specifically, and this agreement they're going to try and strike with this union, what would a fair wage increase be? Can you put a number on it?
Well, I will say the same thing that I said when I was out the ports talking to the parties. A fair contract is one that the members are going to ratify. So a fair contract is something that that workers choose at the end of the day. And again, that process is important for the parties to be able to negotiate, to be able to stay at the bargaining table, and to be able to resolve issues. And I do believe, and as has been shown time and time again, there are win-win solutions there.
Don't we have to be careful there, though, if we start saying things like fair is whatever the union wants?
Right. So, I mean, at the bargaining table, right, there's all kinds of issues that we have seen throughout history, that when workers can bargain alongside employers who are committed to, employers who understand that the best investment they can make is an investment in their workers, there's all kinds of things that can happen when it comes to wages and working conditions and benefits, and those are the kinds of things we want for every American worker, right? We want stable work. We want a path to the middle class. We want security in retirement. We want health benefits. We want leave. Those are all things that the president has prioritized. And I think those are all elements of what it means to have a good job.
There are issues you're working on, Secretary Sue. I know that. Your nomination hasn't been progressing to take you from acting Secretary of Labour to Secretary of Labour. What's going on with that? Can you give us some information on the timeline you're hoping that this gets dealt with?
So the president has expressed great confidence in me. He's nominated me to serve as U.S. Labor Secretary. I am doing that job. The confirmation question is certainly one for the Senate, but I've also appreciated the broad support I've had from a number of senators, and we remain hopeful about confirmation. And meanwhile, I am here to do the job and do what the president asked, which is help him finish the job. And we're, again, seeing progress and continued growth, and we know we have more work to do, and I'm all in to help get that done.
Are you concerned it's holding up the department's agenda at all?
No, so the work of the department continues full steam. We are, we have enforcement work to do to ensure that every worker gets the wages that they're owed and comes home healthy and safe at the end of the day. We are laser focused on connecting employers who need workers to the good jobs that are being created in the economy, to working people who are looking for those jobs. So that's another big priority for us, and those are very important, and we will continue to do them, and I'm proud to lead the department in these efforts.
Secretary Sue, we're happy to catch up with you this morning following the payrolls report. Thanks for being with us. Julie Sue there, the acting U.S. Secretary of Labour down in Washington, D.C. Following the payrolls report from about an hour and 21 minutes ago, with us for a final thought, I'm pleased to say Victoria Fernandez, Michael Collins, still with us. Victoria, let's talk about this market and equities. Equities have absolutely ripped this year. And in fairness to those that have been optimistic about the labour market, including this administration, last year, if you'd asked us where unemployment would be, I'm not sure we'd say in and around 3.5% 12 months later, and here we are. At the start of the year, if you asked where equities would be, I'm not sure we'd say up 16% on the S&P, down to about 15, 14, whatever it is now, on the S&P 500, the Nasdaq up by close to something like 40% year to date. Victoria, what did we get so wrong and what has gone so right?
Yeah, it's an interesting observation, Jonathan, because I am one of those people, as you know, that was not as optimistic on this market, and we really thought that we would see a recession somewhere around the middle of the year. Now we look at that closer towards the end of the year, still thinking that there's these elements out there that should cause us to have a little bit of caution, whether it's money growth, whether it's inverted yield curve, the rate hikes that we've seen from central banks around the globe, all of these things. But we've had some elements come in to really support this economy. When we had the bank issues in March, we had the Fed step in and put a tremendous amount of liquidity into the market. We saw the TGA spending in the first half of the year. That was a tremendous boost to the economy as well with the liquidity component. We've had a consumer that I think has stayed stronger than what people anticipated. Another force for the economy to continue to do well. And I think you've had rates up until this last week, rates for most of this year have stayed somewhat contained. That again, or yields I should say, not rates, but yields on treasuries contained, that's given a boost to the economy as well. I think what we've seen over the last week with yields moving higher, I mean that 3.90 to 4% range we thought we'd be stuck in for a while, we sliced right through that this week, and we saw the market pull back. You look at gilts. Gilts yields are back up to where they were back at the end of last year, and you've seen that equity market pull back about 10%. Same thing with bonds. So I think we need to look at some of the issues that are occurring that could pull the market back, but up until now, there has been quite a bit of support for the economy that I think most people thought would be on the downside by this point.
And Mike, I want to give you the final word. I've got about 30 seconds left. The final word is yours, sir.
Yeah, similar thoughts, Jonathan. I think if the markets start pricing in more of a permanence to this higher level of rates, i.e. four-handle, intermediate term 10-year Treasury yields, I think that has to put pressure on valuations of all assets, right? Last time rates were this high, equity multiples were lower. It's really tough to justify, I think, equity multiples, real estate valuations on other types of debt if rates stay at these levels.
Mike Collins, Victoria, to the two of you, thank you. Your trading diary up next.
Great questions.
Here's the training diary. The NATO summit kicking off on Tuesday. CPI data Wednesday. Jobless claims Thursday. Then on Friday, bank earnings begin. JP Morgan, Wells Fargo, Citi, all coming up. From New York, that is for me. Enjoy the weekend. Thank you for choosing Bloomberg TV. This was the countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
All right, 30 minutes into the U.S. trading day, Friday, July 7th. Here are the top market stories that we are following for you at this hour. It's a confusing jobs picture. So payroll number disappoints, wages rise, unemployment falls. You got something for everyone. We're going to get a big takeaway. And higher for longer. We speak to Bruce Richards, Marathon Asset Chairman and CEO, says the Fed funds rate will be at 5% this time next year. We're going to get his take on jobs, the Fed, and what he's buying on the cheap. And it's a bad week for bonds. Two-year yield hitting its highest level in 17 years. Yes, we're fading that a little bit. Stocks also mixed on the day. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. If you were to ask me for a really big takeaway from today, I don't know if I'd have one for you, and I don't think the market does either.
I think we need to widen the lens, Alex. I think we need to take all of the data in aggregate and figure out what we've really learned. I actually don't think the 2 years gone very kind of far this week in some ways. I think the week started on the 5th. It didn't start at the beginning of the week, so I don't think we've actually gone very far. What do we really know here? We know that the labour market is still strong. We know that maybe there is a slowdown taking place, but the pace of that slowdown looks fairly anemic. It is happening, but it's happening slowly, and wages are holding up. But we knew that already, didn't we?
Yeah, I also find what Cameron Kreis read about, and he was saying that it's a gray zone economic data, right? Like it's gray. It's not black and white. There's something for everyone, and parsing that through is quite difficult.
Absolutely. You can pick your number. You can take a different approach, and the data will support you on that. But you aggregate it all together. You think about what we've had this week. Started the week with the ISM manufacturing. We've had ISM services. We've had claims. We've had the JOLTS number. We've had the ADP number. We've got the payroll number today. So what does that in totality, because remember the Fed likes us to look at the totality of the data, tell us about what is really happening? So our question of the day is this. What did the labour markets teach us this week? Trying to figure that one out. Mike McKee, Edward Harrison. Mike, what did the labour market teach you this week?
That it is still strong, and that the Fed is probably going to be raising rates in July. I'd say that's almost a certainty now, and leaning that way for September, depending on what we get for the July and August data, because we are sort of, we've been thrown off by that ADP report yesterday. 206,000 is still a very strong number for job creation this far into a recovery, and with interest rates where they are from the Fed. So there's still a long way to go for them in terms of bringing down what they think might be inflation-causing wage gains out of this tight labor market. 3.6% unemployment, 4.4% annual raises for people. It's not all bad, because now we're finally seeing wage gains above inflation, but the Fed needs to do more, they think, and these numbers support that.
Ed, you write a lot about how we're looking at a recession at some point. Do these numbers, the numbers over the whole week, do they help frame that any better? Do they help make you nervous about the call?
No. Well, I should say yes, actually, in the sense that what we're at now, we're at the highest levels in terms of economic surprises to the upside that we've seen in quite some time. If you look at some of the numbers, it's almost vertical in terms of the surprise versus almost all positive surprises. And that's a mean reverting series. That's the problem, obviously. The real question is, about this specific data point. This specific data point, it is that gray zone, I think, that says it's about as good as it can get for the bond market. It's slightly lower than was anticipated, but it's still good enough to say that the market's going well. However, if you look at it from a macro lens, if you take the rolling average of these particular numbers, what you're seeing is the unemployment rate, the number of unemployed reaching a bottom in April, and it's actually ticked up both in May and in June, both in a 6-month and a 12-month rolling basis. That suggests that that 3.4 number is the lowest for this particular cycle.
Is this still full employment, Edward? Because that's part of the mandate for the Fed. Is this as close to full employment as we're going to get from a Fed point of view? Because if it's ticking that box, it definitely isn't still ticking the inflation box. So if it's got one box ticked but the other box is not ticked, presumably it has to do more to tick that box.
Right, yeah. So I think that what Mike was saying earlier about it seems like a lock for July is spot on, and then September, it looks likely that they're going to go in that direction. We're not slowing enough for the Fed to feel comfortable that given where inflation is, that they can stop the rate hike trend. So I think that you'll get 25 basis points, you'll get another 25, and then the question becomes how long can they hold at that level given the weakening that I see already happening and likely will precipitate a second half recession.
I want to jump in there and follow up on what you're saying, Edward, because when you ask about full employment for the Fed over the last couple of years, it became not just full employment in terms of a number, but full employment for everybody, trying to reach down into the minority groups, into the less educated, and get everybody a job. And you look at what's happened in the last couple of months, and we just had a chart up a minute ago, and if we can go back to that. If you saw what happened today, since April, we've seen black unemployment unemployment rise to 6%. We've seen Hispanic unemployment rise while white unemployment continues to go down. The people at the lower end of the income scales, those with high school degrees or less than high school, are seeing their unemployment rate rise significantly. And a statistic that I found notable today, when you look at what's happened with black employment over the last 2 or 3 months, black employment is down significantly over the last couple of months. 374,000 jobs lost there. So what does the Fed do about that? That becomes an interesting question. If that was their reason for letting the economy run hot, are they losing all those gains?
Right, because it's not actually working out. And then you wind up have student loan issues as well. So you're going to start paying back your student loans in the beginning of the year also, and sort of how that's going to work out with the jobs picture. So I guess on the question, Guy, so Guy and I debate the question of the day sometimes at length early in our editorial meeting. And my question of the day was, is this higher for longer? And then also how long? Yeah. And when you wrap in sort of what Mike's talking about in the economic gray zone, does the longer really start to bite?
So maybe we're already in the longer phase. You get a take on this in just a second. My take on this, Ed, and you can criticize my take because I'm sure Alex will tell me it's wrong. My take is that we are already in the higher for longer phase. Edward, this is rear view mirror stuff. The labor market works with a lag. We're already into the higher for longer. If this was what the market was doing a few months ago, effectively we're already seeing the slowdown. Where are we in reality now in terms of where we are with the labor market versus where rates are? That's the conundrum that I'm trying to grapple with right now.
I think we're in the descent phase. That is that, the numbers that Mike McKee was talking about, that's going to bring a descent from those individuals on the FOMC that are concerned about whether, the labor market cracking, and particularly for members of the community that are most vulnerable, that, the people who get onto the income ladder last. And so I think that we're going to start to see descents. So we'll have a hike probably in July. Maybe we'll have one in September. But if we do, then we're going to have descents. And then the question becomes what does inflation do over the coming months that allows the Fed to either continue that high plateau or then to cut? Because once the labor market starts to deteriorate significantly, that's when the bond market will start pricing in more cuts that they've now taken away.
Really great conversation and wonderful setup, and does really illustrate that gray zone that we're kind of all living in now. Mike McKee, Edward Harrison, thank you both very much. So coming up, we're going to get more perspective on that question of the day, Guy's question of the day. What did the labor market teach us this week? Bruce Richards, Marathon Asset Management Chairman and CEO, coming up next. This is Bloomberg.
Next week, all eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Tuesday, July 11th, right here on Bloomberg.
Jobs report. It represents steady and stable growth, which is what we want. It shows that the president's policies, Bidenomics, is working. It's combined with a 3.6% unemployment rate. Many predictions were that it would not get below 4% right after the pandemic-induced economic crisis for a long time, and these policies have defied that. And in fact, we've seen less than 4% unemployment for 17 consecutive months now, which is the longest duration since the 1960s.
That was U.S. Deputy Secretary of Labor Julie Hsu speaking last hour on the jobs data. And that brings us to the question of the day. What did the labor market teach us about this week? Or this week, what did the labor market teach us? Maybe I can get the question.
Get it right.
I know.
Get it
If
right.
I'm going to say your question, I got to say it right. All right.
Precisely.
So joining us now, Bruce Richards, the chairman and CEO of Marathon Asset Management with $20 billion in assets under management. Bruce, good to see you.
Good to see you.
So we've had a lot of data this week, a lot of different areas of the economy. What's your takeaway when it comes to the labor market?
Unemployment looked really strong because although it missed by a little bit, I wouldn't overinterpret that. There's 152 million Americans that work here in this country, and if you're off by a few thousand here or there, not a big deal. The number was over 200,000. ADP, 497,000, so strong numbers. And with wages going up 4.8%, wages are looking strong, and unemployment number at 3.6%. So overall, numbers strong.
Bruce, the labor market's going to be great until it isn't. When do you think it's going to enter that phase where it isn't?
Guy, it's a very important question you asked there, because it's strong until it isn't. And one of the things we've been studying is going into a recession, do you see signs of unemployment starting to tick up prior to the recession? And the answer is no. Unemployment's always strong. Go back and check all the prior data of all the prior recessions. Unemployment's always been firm going into a recession, and where it starts to weaken is when a recession starts. And so when that recession starts is when you're going to see the big job layoff announcements, and not prior to that. So I think...
Okay, so Bruce, do we need to see a negative print for that indication to be clear enough to everybody that a recession has started? Is a negative payrolls print what we should all be waiting for?
Well, in recession's also backward looking as well, because recession is defined as 2 negative quarters of contraction, and so you'll know that 6 months out from when the recession started. But what I'm saying is when the recession starts is when you see the unemployment goes out. So you won't have to see the print of a recession, but you'll start to see the onset of a recession when that exactly happens.
It's not predictive.
The point is, it's not a leading indicator. It's not predictive.
Yep.
So are we going to see then higher rates for longer? It feels like the message has been high rates. Yeah, we got that. Do we get the longer part yet?
I think we don't get the longer part yet in terms of what the market's interpreting, but I think you're 100% right, Alex, as you usually are.
Oh guys, come on, I'm blushing here.
So the question is higher for longer? Yes, higher for longer. Now, what the Fed Fund futures tells you, when you look at the futures contract, is by year end, it starts to roll over. I don't believe that's going to happen, because I think we're going to be much higher for much longer than what people think. And that then has very much a predictive component to how you want to invest, where you want to deploy capital. Is it equities or is it debt? And what combination of that? And what type of companies you want to invest in? And so there's a lot of information here to unpack if you have a higher for longer scenario, which is what you think, and which is what our base case is.
I'm assuming in that scenario you want to avoid anybody with leverage, anything with leverage. You just want to avoid leverage.
Avoid leverage. And so where do you see the leverage? You see that in the consumer, lower FICO scores, consumers that are highly leveraged. You see that in commercial real estate, in parts of the commercial real estate marketplace that are highly levered with debt maturity walls coming up. And of course, companies. So you look at your typical single B rated company, they're now starting to burn cash just to service debt. So your typical company is a middle market company. I'm not talking about S&P 500 companies. I'm talking about the middle markets. Was throughout America, thousands of companies that have borrowed in the high yield market and borrowed when rates were low. And they borrowed borrowed too much money when rates were low, thinking rates would stay low forever. It was a free form of capital or a very cheap form of capital. So for those companies today, take a typical company with $50 million of EBITDA. Remember, EBITDA is before your debt service. And that company maybe had a $30 million debt service requirement per annum before the Fed started raising rates. Well, raising rates from 0 to 5% Fed funds has now caused that borrowing rate for the company to go from 5% to 10%. And that increase in rates has caused their borrowing costs to go from $30 million in this example to $60 million. Wow. So now they're burning cash to service debt. So why do we have the greatest number of middle market companies filing for bankruptcy since 2010, this far into the year? Because of this exact reason, the fact that debt service has become so expensive.
But to that point, like, so I mentioned it earlier that you see a 5% Fed funds rate at this time next year. You mentioned defaults for these kind of companies kicking back up to the highest we've seen in 2010. Why aren't we seeing that in the high yield market? Like, why aren't we seeing that in spreads? Because
I think there's a big bifurcation of quality. And when you look at the BB credits in the high yield market, that's a much better quality index than it ever has been, so you don't have many of those companies because they chose to lock in fixed rate bond yields as opposed to floating rate. I'm referring to the companies that took out floating rate notes in both the private credit markets as well as the syndicated loan market. That's where you're seeing the pain right now. Those are the companies that are most highly levered and that are showing the most stress as it relates to debt service.
Bruce, you're getting paid to sit in a money market fund. You're getting paid handsomely to sit in a money market fund. People are going to want a little bit more from you. What kind of yields are you getting right now, and where are you getting them?
It's a great time, to your point, to be in money market funds, and that's why you see it at $5.4 trillion, a record number of money market funds that exist out there right now. So what we're doing at Marathon is we're buying these high-quality, high-yield bonds and loans that are yielding 8, 9, 10%. That's liquid, and then we're in the private credit markets in asset-based lending and in capital solutions and middle market lending to companies earning 12 to 15% IRRs, 12 to 15% returns. And one sector we've dived pretty deeply into is commercial real estate loans. So for a particular commercial real estate loan, you have to get that property right because it's a single loan. But when you deal with 100 loans in a CMBS transaction, now we can go through and evaluate all the loans in that transaction and take out the ones that are going to be the poorly performing and see how that hits the waterfall of hitting the lowest tranches first. And what we've been doing is buying into the safety zone, kind of those triple Bs and single A tranches that won't have any impairment of credit. And we've bought about $250 million of those securities, yielding about 15%. And so we feel very good about the kinds of returns that we're making in the marketplace. At the end of the day, look, stocks, nothing's on sale right now when you talk about the market. In the credit markets, everything is on sale.
How good is the sale?
The sale's pretty good. We're buying these bonds, to yield 12, 14, 15%. Right. So compared to like the 3, 4, 5% yield that you used to earn on these assets, going back before the Fed started raising rates, it's a gift. The saying is, don't fight the Fed. Yeah. It's more than the saying. It's a big investment strategy, and you want to ride that wave. So the Fed has just given us 500 basis points of extra base case return, giving the credit markets the best risk reward in terms of the return that we make relative to risk. Think about private equity for a second. Private equity used to pay a 5% rate to fund the companies when they purchased a company. Now they're paying us 10% to 12%. So it's the same company, the same revenue for that company. We're just making twice as much money as we did, which means there's a lot less return for the shareholders of that company.
Yeah,
including the private equity
sponsor. We're now speaking, Alex. We're definitely speaking Alex's language now. There isn't a sale. There's no sale on in the equity market, but the sample sale is definitely happening in the credit markets right now.
Yeah.
That works, doesn't it, Alex? I think we can all understand that.
And then I wrap in some crack spreads, and we're good to go. We can all make that work. Hey, Bruce, I really appreciate it. We love having you. Great analysis. A good day to have you. Bruce Richards, Marathon Asset Management Chairman and CEO. All right, still ahead, you got Apple revealing the details of its Vision Pro rollout, kind of underscoring the niche and complex nature of the mixed reality devices. We're going to have details from the startup next. This is Bloomberg.
About that all day yesterday.
It is 20 past 7 on the cloudy West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, the story we want to hit on is Apple. So it's kind of slow rolling, this $3,500 Vision Pro headset, I should say. Why? What is it going to look like if I want to go buy one?
Yeah, this is important reporting from Bloomberg's Mark Gurman, and we're learning about how Apple's going to roll out the device to customers. So according to sources in the near term, this is going to be quite restricted, by appointment only, in key flagship Apple stores in major cities. Think in the first instance, New York and Los Angeles. You're not just going to be able to walk into an Apple store anywhere and try it, get your hands on it. If you do live in one of those major cities, like you, Alex, in New York, according to sources, you will be able to get yourself an appointment, go to the store, demo, try on the headset. But, you know, it reflects the kind of scaled back and scaled down ambitions that Apple has for its first year of sales on this product that other outlets have also been reporting on in recent weeks.
Ed, why has Apple got this so wrong? Maybe I'm being unkind here, but expectations were so high and they are now underachieving on that front.
Yeah, one thing that Mark cites in his reporting is the accessories. You know, if you think about your iPhone as a parallel example, if you have one, it comes with the idea you need a case. What are you doing about an external battery charger, which is analogous with the Vision Pro, the charging infrastructure for it, care kits, things like that. And according to Bloomberg sources, the logistics of the accessories has been an issue. You'll remember, I think we talked about this on the show in the week of Apple WWDC. Bloomberg's reported that the original goal was 900,000 units in year one, which sounds like a lot, but it's not really in the scheme of things. And the FT reported that target of 900,000 has now been halved due to, you know, both demand but also the complexity in supply chain of launching a new product to market.
So Ed, this was my other side of that coin, was that how much of this is actually just Apple can't get the stuff made, so they do want to slow roll it because they're just not going to have it.
Yeah, complexity of the manufacturing process. You know, when we were at Apple WWDC in Cupertino that week, and we were reporting that 900,000 units in year one was the target, lots of analysts jumped on that and said that it reflected that Apple had been ready for some time, both on the supply chain and component side, but that the manufacturing was set and ready to go. An element of the Financial Times' reporting is that actually it's more complex and that may not be the case. But again, $3,500. This is for the early adopters, the developers. This is not a mainstream product at this stage.
Certainly not. We'll see where it goes. You're going to tell us exactly what's going to happen and give us a heads up on that, Ed, as ever. Thank you very much indeed. Ed Ludlow. You can catch Ed and Caroline, Bloomberg Technology, which is a great place to figure all this stuff out. 90 minutes time coming up on Bloomberg Television. Coming up, more on our insights into my question of the day. What did the labour market teach us this week? Kate Barnes, Director of Research at the think tank WorkRise, joining us next.
We're about an hour into the U.S. trading session. Kind of interesting. Stocks overall pretty much going nowhere, but individually it's some confusing signals occurring when it comes to the cyclicals. Abigail's tracking these moves. Abigail?
Yeah, well, here's the no moves for the S&P 500 and the NASDAQ 100, basically down just a little bit after that disappointing, mixed jobs report. But take a look at the strength that we have for the Russell 2000, up 1.1%. Banks up by about the same amount, so a little bit of a reprieve for that R2K, which yesterday hit down on the support or thereabouts of its various moving averages. So folks moving back into some of those domestically based growth companies, or maybe more so some of those banks. As for the week, it's a down week for the S&P 500, and one of the drags on the week is big tech, down 1.2%. Now within the tech sector, Apple is really a drag. It's not even down 2%, but it's its worst week since I believe March 10th of this year, really speaking to the degree of the rally that took it to that $3 trillion mark and then back below. And then if we change up our boards, we are going to see, so there is, of course, aside the Japanese biotech company, on the year, or over the, on the year, up about 10%. You can see this big pop, and that had to do with their Alzheimer's drug earlier. Right now, today, it's about flat, but nonetheless, they have received approval for their Alzheimer's drug use, but with restrictions. And then finally, maybe the biggest story in the week, Guy, yep, you guessed it, yields. Take a look at the 2-year yield. It's already closer to the Fed funds target rate. So, but although it's interesting, I really expected it to stay firmly above 5%. That hasn't happened. But on the week, we do have the 5-year and the 10-year yield both up impressive amounts as bond traders once again recalibrate for the Fed.
Absolutely. In a massive week, we've actually had some volatility, which has been exciting. Abigail, thank you very much indeed. Let's get more into the data that Abby was just referencing. What have we learned in totality this week about the labour market? What did the labour market teach us this week? Kate Barn, Director of Research at Workrise, joins us now at the Urban Institute. Kate, what did the labour market teach you this week?
I think overall it still is moving in the right direction because we want to see is continued job growth, but not so much that we think we're risking overheating. And I think hitting at 209,000 jobs added with unemployment at 3.6 does seem to meet that mark. That shows that there's still room to grow, there's still jobs being added, but it is not so much that we should really be worried yet.
So, Kate, what I find hard to also understand is that the typical signs that the job market's going to roll over aren't necessarily the signs that we're seeing, right? Like manufacturing jobs increased, construction jobs increased in the jobs data. Are the signals that we need to look for different this time round?
That's a good question. I think, we are looking for signals, but I don't see those. So I think your read is actually pretty correct. I think, in particular, as you noted, construction and manufacturing are growing. Another good sign is that service sector jobs are growing, in particular government jobs are growing. If we compare it to the Great Recession, it really lagged in public sector work. And this is a really critical sector for ensuring we have a resilient economy, since a lot of public sector work is the work that makes other work possible. And so I think, it is still moving in the right direction.
Sorry.
We don't really see that decline. Sorry.
Is this still full employment? If you were at the Fed, would this look like full employment?
This does look like full employment, but when you ask about the Fed, that's a pretty critical point, because what we have seen in the past few years is that even though we might be nearing full employment, that does not seem to be leading to the wage pressure that is leading to inflation. So workers making gains, there might be full employment, evidence of those wage gains that workers are making, but it is not impacting inflation, and so that's the key part that the Fed should be looking at.
So wages can go up because wages are not leading inflation. That link is a little bit broken, so then it's okay?
That's what I think. I mean, that's sort of my read of the data. I think that's what we've seen in the past few years. There's not a lot of evidence that wages are leading to inflation. Wages are going up. And one thing I think I like to bring up over and over is that we are facing, decades of increasing income inequality. We used to have a much less unequal labor market. And now it seems as though, the past 2 years, research has found the past 2 years has reversed almost a quarter of the past 4 decades of growth in income inequality.
Wow.
Do you not worry that we're starting to see minorities, though, have their unemployment rate start to rise? That is something that the Fed has talked about in the past. It wants to have a broad labor market. It wants more people to participate and benefit.
That's a good point. And I'll sort of look to the late economist Bill Spriggs, who passed away recently, who always looked at that sort of gap between black and white unemployment rates. Black unemployment did go up last month, and over the past 3 months, it went up a full 1 percentage point, and that was statistically significant. But that is also compared to the fact that the black employment rate, so not the unemployment rate, but the employment rate, is now only 1.5 percentage points lower than the white employment rate, and that is historically close for employment rates between black and white workers. So when you look at both the unemployment rate and the employment rate, what I see is there's probably more room for growth for black workers, but they have made major gains in the past year or so.
I mean, this might be too short term, but the repayment of student loans that are going to kick in the end of August, beginning of September, what's the risk that that really dents that and skews that labor data even more?
That will remain to be seen. I think where we might see that is we've seen a lot of people going into better jobs. They've been more effective at searching for better jobs and finding jobs that pay them better. When workers are facing more costs like debt repayments, they might be a little backed in a corner and have to accept a worse job. So I think that's the risk we see, is that when workers have more monthly payments, they might accept a worse job because they can't spend as much time searching for a good job. But I think that really will remain to be seen.
Kate, one of the issues remains that we have a supply-side issue in the labour market. What is policy currently doing enough to address that supply side? What could be done in addition to what is already being done to improve it?
I really like this question, actually, because I think we've seen employer demand, and that's good. That's where we see these wage gains. But we also need to impact the supply side, and I think that is where we think that a lot of government policy would be effective, because you need both sides of that equation. And so government policies that I think would help the supply side are things like making sure jobs are safe and secure, particularly for older workers, making sure that people have access to benefits like paid leave, paid sick time, the type of things that workers need to balance their full lives. And so I think if we want to impact the supply side while we have this strong demand, we really need those wraparound types of job quality measures.
What do you make then of the strikes that are happening, particularly, say, at UPS? Southern California is also undergoing some issues. Like, why do you think this keeps happening now? And is that indicative of something else?
I mean, I think there's a big pent-up demand for labor action, might be how I interpret it, that workers have not had the stability to really ask for what they need at work. And because the labor market continues to be strong, there continues to be a lack of evidence of a recession. That gives workers the leverage to ask for the things they probably always wanted. And so when we talk about these UPS workers, they've been asking for things like air conditioning in trucks, which is really a basic workplace safety issue for them, for over 20 years. And so I think, these are things they've always wanted, but they finally have the leverage because the labor market continues to be very strong.
When the recession comes, do you think that Labour will be able to what extent will Labour be able to retain some of the benefits that we have seen being ascribed to it as a result of the tight labour market that we see currently? Kate, is this a one-off or is this going to be sustainable?
I think that sort of remains to be seen, but depends a lot on the policy environment. I think the degree to which we can bake in the recent gains will depend on how much there is government support and institutional support for those gains. And so we've not seen sort of, wide-scale changes to our labor policies in the past few years. We've really been relying on those competitive forces. But in order to ensure those are maintained, we do need things like policies that ensure that they are baked in. And so, my quick list of those would be things like a higher minimum wage, making it easier to unionize a workplace, enforcing the labor laws we already have on the books better than we currently are. And so we really need those institutional changes to make sure that the recent gains aren't lost.
Kate, we really appreciate it. It's always fun to get your perspective. Kate Bond of WorkWise, thank you very much. Here's some breaking news for you. So the Polish Central Bank formally ends the rate hike cycle, and the head of monetary policy saying that the next natural step will be a move in the opposite direction, saying that a rate cut is possible of 25 basis points in September. The funny thing is, Guy, is you're actually seeing strength in the Polish currency versus the euro.
Yeah.
You cut rates, you get a higher currency. That's not normally what we think.
I wonder whether there's some expectation as well that it could have come earlier. Maybe the Poles raise rates and have had them for a while, have had them up at quite an elevated level for quite a long period of time. So I do wonder whether or not actually this is coming later than the market would have anticipated. But yeah, this is a central bank. It's not a major central bank, but it is a significant central bank talking about rate cuts.
Yep, just sort of the beginning of that coming in. All right, coming up, we're going to talk more about the U.S. jobs number. Manufacturing sector actually adding 7,000 jobs in the month of June. We're going to get the bird's eye view of the industry with Mark Rayfield, Saint-Gobain North America President and CEO. This is Bloomberg.
The listing exchanges of commodity ETFs have information sharing agreements with derivatives exchanges because that's the organized marketplace where transactions happen. Crypto is a little different in that spot crypto, physical spot crypto, is traded on organized marketplaces such as crypto exchanges. And hence, we haven't quite been here before. There's no exact parallel. However, in the relationship between spot markets, ETF markets, and derivative markets, that is a well-trodden path.
Sue Chung, CEO of CF Benchmarks, talking on Bloomberg Crypto yesterday. They're providing the pricing for BlackRock's crypto ETF. This would be huge, the first spot crypto ETF. It obviously has a Bitcoin ETF. It obviously triggered a lot of move into Bitcoin. I do have to say, Guy, that JP Morgan doubts that this U.S. Bitcoin ETF is going to be a huge game changer, and it may not be the big shift in popularity that the street may be thinking about.
Maybe, but it would be a big step forward. This has been, it feels like this has been a big line that the industry has struggled to get over. And getting one approved would be massive. And BlackRock has a huge success story. I think somebody crunched the data at Bloomberg. They've only missed once. i.e. they make sure they are going to get regulatory approval before they apply for regulatory approval, and that's where they are now, and therefore you have to assume that the stats work and they get it.
Yeah, exactly. I love that story. It's like you kind of wait until you know it's a done deal, and then you get into it. Okay, so let's see if it happens, and then see if it takes off, and see if you're going to get the inflow of investors like maybe you and me who maybe wouldn't have bought it. That's going to be the big game changer for the Bitcoin ETF.
It's interesting if you actually take a look at what has been driving Bitcoin though recently. There has been this kind of expectation that you would see this ETF approval being a huge kind of moment, but actually in reality what's been driving it recently is that there's a lot of speculative money in there, there's a lot of leverage that's come in as well, volume's been kind of relatively limited. The rally isn't built on exceptionally solid foundations if you take a look at the fundamentals.
No, but it is tracking tech less. I feel like a year ago it was more or less a tech proxy, and it feels like it's going a little bit more on its own tune. Anyway, should we go back to jobs?
Why not?
Yeah, let's do it. Okay, so what's interesting in the jobs report is the manufacturing industry overall is sliding deeper into a slump, but the numbers today weren't that terrible. On Monday, Guy caught up with Tim Fiore, the chair of the ISM Manufacturing Business Survey Committee, and here's what he had to say about layoffs.
For the first time in quite some time, we're seeing layoffs come more into play in the month of June than we have since the pandemic recovery. So, I've been tracking the hire to force manage ratio, which is who's hiring and who is trying to manage their headcount down. This is the first month that I saw a shift in the amount that layoffs were of that force manage ratio compared to freezes and attrition.
Joining us now is Mark Rayfield, Saint-Gobain North America President and CEO. Saint-Gobain manufactures building materials, roofing, siding, insulation, and solar panels, and is the U.S. is its largest market. So, Mark, not only do we have the pessimistic view, say, from Tim, but then the actual numbers on manufacturing and construction jobs today were good. How do you rate what's happening in your industry right now?
Well, I think in our industry and across construction and manufacturing, we're seeing still some strength. And we've had a good 3 years of performance, and it's based on the support of our 18,000 great colleagues. And they really make our business. I think every smart business understands that. So we're retaining our good employees. We're working on attracting new employees still to this day. So I think the construction industry, as we said, fundamentally is very strong as far as the need for new homes, 17 million over the next decade. So we're optimistic.
Is the construction industry starting to re-accelerate, Mark?
It's starting. You saw the numbers get better in May, guys, so you saw some improvement there, but the construction industry has been quite robust throughout this year. I mean, commercial construction a bit weaker where you're looking at office space, but residential remodeling has still remained very strong. So we've seen extremely strong sales and support through this whole year, with some of our businesses still being on allocation in North America for construction products.
Why? Why hasn't 500 basis points of rate hikes from the Fed dented this part of the economy?
I think you can't overcome the base fundamentals, that there is still an underbuilt environment for housing today. I use New York City as an example. When you see the people not coming to the office, where are they? They're at their homes, sometimes nearby or sometimes new homes. So people are changing their lifestyles. The family creation's growing. So there's 4 million homes that need to be built just to catch up, and 17 million needed over the next decade. So that fundamental overrides, I think, the mortgage rates. Plus, people have cash, and they put the down payment. So I think if they can do the down payment, that's always been the biggest hurdle in housing, in my opinion.
Mark, you talked about a moment ago the fact that you are able to retain staff, that you are able to get the staff that you need. Couple of things on that. What do we need to do to improve the availability of staff? What are you doing to improve the availability of staff? The supply side on the labor market is the bit that continues to confuse me. It is a real struggle to find the people that you need. Is that because there aren't enough people, or aren't enough people that A, are qualified, and B, want to work at the right time? Kind of what is going on in terms of the supply side?
It's a very complex question. It's very regional, of course. I think the reality of the fact is people are looking for a broad portfolio when they look for a company to go work for. They're looking for a culture that fits them, so they're looking for a purpose that fits what they want to do going forward. They're looking for flexibility in work. They're looking for the right benefits. And all of that ties in. So people aren't just looking for a job in an industry. They're looking for a career and a place where they can feel a sense of belonging. So we really focus in each of our areas to try to recruit locally, to reflect the communities that we work and we live in, and that's how we try to attract our talent. And we work on culture.
Okay, let's game this out for a second. Let's do the what if. What if we do get a recession and tough times, okay? Right. Are you going to keep the workers on your payroll even if it hurts in the short term because it's hard to find them now?
That would be our expectation. We are not adding a lot of workers in the central services, so to speak. I mean, we've always been very disciplined in that part of our G&A because I believe that we're in a cyclical market no matter what market you're in, so you'd be disciplined in up and down markets, that area. In our manufacturing facilities, we have used temps and overtime to flex up and down, and we try to manage it that way, so for our full-time labor, it stays consistent. So our goal is to get the right labor force and hang on to them. I think most companies are doing that, particularly when you're looking for engineers and technical resources.
So the lesson recently has been don't let people go because they're too hard to bring back. Is that the right lesson, Mark?
I think it's the right lesson. When you get a good employee, a good colleague, you train them, they get embedded in your culture. You know, that's a 6-month to 12-month learning curve in almost any business, and you really want to hang on to that talent. You want to grow them internally and show them that in manufacturing and construction, these are fantastic careers, and you can start on the shop floor and you can have this seat someday. I mean, if you want to work towards that level, where you can be a supervisor, run a plant. So we really want to retain our great employees, and a lot of that is around the right packages. A lot of it now is around the right culture.
If we go to margins for a moment, the theory as we head into broader earnings season is that falling inflation is going to be good for margins. It's going to be a good time for some companies. Are you noticing that, or is inflation still sticky and you're not going to see the margin improvement?
I would say it varies. I mean, we have seen some deflation in raw materials. Labor is still quite inflated, so that's a big portion of our cost. But we feel very confident. We've been very successful in growing our margins the past 3 years, and we think we'll continue that trend to maintain and slightly grow going forward.
If the Fed came knocking on your door, Mark, and said, what should we do right now? What do you think we should do? Do we need to slow this economy down more? What would you say?
I think I'd tell them to go somewhere else. I'm not sure the right person for them to talk to.
They're not the manufacturing construction guy about slowing the economy.
Yeah, I'd be very nervous. I mean, I think that the economy is resilient. I think what some of your earlier guests said, there's 2 more raises kind of baked into what people are thinking about right now. I think people think it'll stay longer. And I think what we've seen, at least in the markets we're in, is there's still a demand and a demographic change that is resilient in our markets. So if they do that, I'm very confident in the construction markets. I'm very confident in the manufacturing markets. And the point I really wanted to make is I think these jobs are great jobs. They're great careers for people to have. And you can really do anything with them. So we're big advocates for it.
So aside from labor, which you've definitely driven that home, that we get it.
Okay.
We know what you're selling. We got you. Okay, so we said aside from labor for a second. What's your biggest problem right now?
Biggest problem right now, I guess the uncertainty.
Like lumber prices would have been that a few years ago, right?
You know, I think right now is the uncertainty and also the regionality of the businesses. So, you know, you have, if you particularly in construction, you have, you know, stronger activities in the southeast, less strong in the west. So the regionality continues to move. And so when you have 150 manufacturing sites, you have 150 different regions you're serving, and you have a lot of different variations there.
Interesting.
Mark, I'm glad you didn't say what you would say to the Fed to us, because it's been great to catch up with you. Thank you very much indeed. We really appreciate it. Mark Rayfield, Saint-Gobain North America President and CEO. So thank you very much. This is Bloomberg.